Hello, good afternoon from Geneva to everyone, and welcome to the penultimate seminar of this spring of the International Macro History online seminar series. My name is Anna-Riikka Kauppinen, and I'll be moderating the seminar today. So we are very glad to welcome Dr. Linguère Mously Mai, who is an economist based at the African Development Bank in Abidjan, Côte d'Ivoire. She's currently the Principal Fragility and Resilience Officer at the Transition States Coordination Office of the African Development Bank. So the title of the co-authored paper today is The Colonial Origins of Banking Crisis in Africa, which we very much look forward to hearing. But just before we start the presentation, just a few words of the housekeeping. The presentation will run for 40 minutes, during which you, the attendees, can already start typing questions in the Q&A space. After 40 minutes, we're going to have 20 minutes for questions and comments to Dr. Maye. So please type your questions with your name to the Q&A chat, and then we may be reading the questions, or you may be invited to say it aloud. Then after 1 hour, we'll have 15 minutes for a more informal discussion when you are welcome to unmute yourself and give comments, questions. So please feel free to stay on after for the last 15 minutes. Okay, but at this point, over to you, Dr. Mbaye. The floor is yours. Thank you very much.
Thank you very much, Anna-Riikka. I'm just going to share my screen. Can you see my screen?
Yes, perfect.
Okay, great. Thanks a lot for the introduction. And I would like to take this opportunity to also thank the organizers for the invitation. So this is a joint work with Lisa Cook from Michigan State University, Prof. Cook, Jane Gerson from University of Michigan, and Anthony Simpasa, who is a colleague of mine here at the African Development Bank. So today we are going to talk about the colonial origins of banking crisis in Africa. And in this paper, we are interested in looking at how events that happened during pre-colonial and colonial times in Africa are shaping the banking system today, with a particular focus on Nigeria. So I'll start with the introduction, and then I'll go through the context and talk about the background on Nigerian banking system. I'll present the data. I'll spend a little bit of time doing that because we also spend a little bit of time collecting the data. I'll present the descriptive analysis, the empirical framework and result before concluding and basically discuss the implication of such study. So even before actually the financial crisis of 2008 and 2009, economists knew that banking crises were expensive. They are expensive, and they are expensive anywhere. If you look at the fiscal costs, you know, these crises, they imply high fiscal costs relative to GDP. And in the 90s, for example, these costs were estimated at 4% for Norway, 6.4% for Sweden, or 8% for Finland. And if you take the case of developing countries, they are much more vulnerable to this type of shocks, basically, because these costs were estimated in Mauritania at 15%, 17% for Côte d'Ivoire, or even 25% for Senegal, which is huge. So really, it is very important to understand the causes of such crisis and what are basically the genesis and also the nature of this crisis. And this is all the more important that understanding these mechanisms behind this crisis would help basically implement some reform and make sure that those reforms would be effective to have a stable financial system, in particular in developing countries. So in this study, we are particularly interested in Nigeria for many different reasons. First of all, Nigerian banks are expanding across the continent. And you have the example of the Guarantee Trust Bank that has offices outside Nigeria, in West Africa, in Côte d'Ivoire, Gambia, Ghana, and so on, but also in East Africa, in countries such as Rwanda, Kenya, and Uganda, or in the UK. And you also have Access Bank, for example, that also have offices outside Nigeria. So really, if you are in such a setting, and if you do not have a monetary authority for the continent that will be able to kind of put some regulations, these banks, in case of shocks, these banks may propagate them from one of the largest banking systems in Africa to other countries in Africa. And then we are taking the risk of spreading basically crisis across the whole continent. And to give you an example, during the financial crisis in 2008, 2009, there was one of the branch actually of the Guarantee Trust Bank that failed in Rwanda. So the risk is real. So we'll come back to this figure actually later on during the presentation, but this is just to show you that basically over time, between 1960 and 2014, there were not fewer bank crises in Nigeria, but more bank crises. And then what we're doing in this paper is to ask why, why was this happening? And to be able to answer this question, we start looking at, this whole literature on initial conditions. And we all know that since a couple of years now, there is an increasing focus among economists on economic outcomes that are set in motion in the distant past. So since the seminal work of Acemoglu, Johnson, and Robinson, you had a couple of papers and evidence that look at the impact of the European colonization in the 16th century on economic growth and development in Africa in recent years. So we thought that it might be useful to examine the initial condition of Nigeria's banking system to see if colonial and early post-colonial conditions could explain episodes of systemic crisis in banking system. And in addition to the role of initial condition on economic performance that I mentioned, this paper relates to various trends of the literature. First of all, this paper is related to the literature around trust. And of course, this literature on the impact of trust on performance, but also on financial development is extensive, right? And basically, trust and social networks more generally play an important role in the stability of the financial system. And if you take the case of Africa, for example, and even Nigeria in particular, the lack of trust in the banking system may explain why people do not hold bank accounts, for example, or why they will be reluctant to open bank account after financial crisis happen in countries. And we also know that above all, if you are in a context of developing countries and Africa where credit markets are very imperfect, social networks, they do play an important role in, providing people with savings or, helping them with their investment needs and so on. So both trust and social networks are important for financial development, above all in such settings. The second strand of the literature that this paper is linked to is the literature on the relationship between diversity and performance in general, but also diversity and performance looking at the banking sector. And actually, if you take the broad relationship between diversity and performance, the evidence we have is not as straightforward as we might think. So on the one hand, you would have evidence that indeed diversity is positively related to performance in general, because you would have different peoples with different backgrounds, different ideas, and so on, that would bring different perspective and experience. But on the other hand, if you have, for example, small groups that trust each other, maybe information sharing would be easier for them. And in this case, maybe diversity may just not have any effect on performance, for example. And if we look at the literature in the banking sector, we have recent papers that are actually showing a trend toward a positive effect of diversity on performance, in particular gender diversity. It's the case, for example, for the paper of Garcia Meka and co-authors that look at a sample of OECD countries, showing that indeed gender matter for better performance in the financial sector, gender diversity. And then beyond diversity, the paper is also related to the literature on related party transactions and corporate governance, because we're interested here in insider lending and how this insider lending can affect asset quality. And I will develop a little bit this aspect during the presentation. And last but not least, of course, this is related to the causes of banking crisis. I don't need to expand too much on this, but maybe just saying that there is evidence of the role of interest groups and coalition that could influence the functioning of the banking system, and that could affect the stability of the financial system. So we're contributing in different aspects to the literature. So first of all, there is little evidence on the relationship between ethnic diversity and banks' performance in Africa. So with this paper, we really aim to bring new insights related to the aforementioned literature on initial conditions and economic development by focusing on the financial system. We're also examining how crises are related to diversity of initial ownership and management structure of banks. And I mentioned it, this paper also relates very much to corporate governance and the relationship between insider lender and asset quality. And finally, we are focusing on Nigeria, which is the largest economy of the continent and the most populous country in Africa. And Nigeria has this large share of individuals and entrepreneurs who are excluded from the formal financial system. And what also makes interesting the case of Nigeria is the fact that the country previously faced a regular episode of banking crisis, as this was documented in Cook 2014. So now let me go through the background on the Nigerian banking system. So to give you an idea of what was going on and kind of a brief history of the colonial banking system in Nigeria, in the paper, actually, we have a table if you're interested into the details that really document the banking system since the 19th century. But here I will just go through the major events that happened during that time. As it was the case in many British colonies in Africa, the British banks were established to basically serve the needs of the British governments and of British firms that were engaged in international trade. So trade was about palm oil or about importing some manufactured goods, for example. And in the Southern Protectorate of Nigeria, this banking system started with the opening of the Treasury Saving Bank in Lagos in the 19th century, in 1886. And it started with only 45 depositors and just over £1,400 in deposit at the beginning of the period. But then this really rapidly developed and increased, because by 1940, this bank, the Treasury Saving Banks, merged with the Postal Service and had more than 49,000 depositors and nearly £143,000 in deposit. There were also other private European banks that entered the market to serve these clients. And these colonial banks, they were dominating the banking sector up to and after Nigeria's independence in 1960. What is also important to know here is that there were three banks. It was the British Bank of West Africa, Barclays Bank, UBA. UBA was a British and French bank. So these three banks were basically dominating the market because they were holding around 90% of the aggregate deposit. So very much little competition. There were not that much competition at that time. And the evidence that we have is suggesting that the colonial banking system was not favorable to Africans at all. And that resulted in a lack of trust of this banking system. Because by design, these banks were there to serve the British interest, not the African interest. And Africans were systematically viewed as not being creditworthy, which led to higher interest rate and other unfavorable credit conditions. And on this issue of trust, it's very important. Uche, 1997, wrote the following. He's saying the belief among Africans that the colonial banks and indeed the entire colonial structures discriminated against them led to widespread mistrust of colonial initiatives, thus further reducing the chances of success for any informal kind of regulation, either from London or from any kind of colonial structure within the colonies. And this is really summarizing the fact that the belief that colonial banks were discriminating and having discriminatory practices against Africans was widespread. And then to react to that, Nigerians in particular created the so-called indigenous bank as a way of protesting. But then not everything went well after those banks were created. And there were lots of issues, lots of problems related to bank failure, in particular the failure of this indigenous bank. So these banks, they did not really have the same power than the colonial ones. And the reason is that they were poorly capitalized, they were poorly managed, and poorly staffed. And sometimes you were even having some fraudulent practices. Both in 1952 and in 1958, before independence, there was some ordinance to regulate the banking system that included increasing the minimal capital requirement, for example. And the consequences of these ordinances were the failure of most of the indigenous banks, basically. And then consumers started becoming doubtful, and they were reluctant, basically, toward all the unlicensed banks. And to just give you an idea of the extent of this failure of these indigenous banks, out of 24 banks that were established between 1929 and 1952, there were only 4 banks that survived after the independence. And then, so what, right? That's the question we ask. So the question is, did these indigenous banks set in motion an institutional environment that could increase the likelihood of banking crisis in the future? So that's the first question. And then, if this is the case, what were the features of this environment that were relevant and that could persist over time? Keeping in mind that there was a lot of ethnic concentration among the initial founders and directors of banks. And to be able to answer this question, we needed to collect data on these banks, both the colonial banks and the indigenous ones, and to also collect data beyond the banks on the environment in which they were created. And I will spend kind of a bit of time explaining the data work. So as you may imagine, collecting data in general is not easy. Then if you want to collect data in Nigeria, it's really not easy, it's not straightforward. So we really had to proceed it by steps. So we had to go to the records of the colonial office, the blue books, which contain information on colonial banks. And then there were also some initial information that was collected on the blue books at Lamont Library at Harvard University. And then we were able to collect the data from the British archives. So we were able to collect various series that were related to the government and the private banks that were operating in Nigeria from 1887 to 1940 from the annual blue books. And we also collected information on the indigenous banks that were established from 1929 to 1960 using various sources of data. There is here Brown and Uche, but we use different sources of data that we detailed in the paper. The nature of the data that we collected is as follows. So we had information on financial data, which means information on deposit, who were the depositors, the withdrawals, loans, the interest rate that were charged, the value of the investment. But we also were able to collect information on the management, the founders, the ownership, the headquarters, the number of branches and establishments, dates of founding and failure of banks, laws of incorporation. However, there were an issue, a hole, basically, a caveat in the blue books. And the caveat was that there was very much little records about indigenous banks. So to be able to fill this gap, we look for other sources of data. And luckily, we found a detailed dissertation that had data on indigenous bank. in and around the time of independence. This dissertation is by Uche, 1997. And from this, we collected data on the name of banks and their management. And we also were able to collect data on ownership. And we had to look for more information about the context for the banking sector from 1960 to 2016. We went through extensive desk research with Google Scholar and other searches to be able to obtain some both historical and contemporary information on this period. And with all of this data, we try to identify the first Nigerian families and their associates who were basically at the origin of the formation of the formal banking institution in Nigeria. So this means that we were able to have information on insiders, such as family members, affiliates, the political partners, in the founding ownership and the management structure of indigenous banks. And then afterwards, what we did is that we matched the name of these founders and directors to data on ethnic names to be able to recover the ethnicity. So we also used some anthropologic literature to make sure that the names were corresponding to, and the meaning of the names were corresponding to the right ethnic groups. And we also rely on our Nigerian colleagues. I think they deserve a credit here because they help us cross-check actually the information that we have that we had around ethnicity and the matching between names and ethnicity and regions of origins. And then we complemented all this information with some macro level data, both individual and aggregate data on Nigerian banks from 2001 and 2016. So we collected statistical bulletins, financial statement, annual report of the Central Bank of Nigeria. We also collected data from system level by Cook 2014 and GDP information, for example, macroeconomic condition from the IMF to capture macroeconomic condition. Sorry. Okay, so with regard to the descriptive analysis, so here in this figure, we try to compare the survival rates of banks by type. So we have the indigenous banks, the colonial banks, the foreign ones, and the mixed banks. So when mixed bank means that the bank was owned by both foreign and nationals. And you could see that colonial banks were the one with the longest survival rate. So on average, they had 109 years of existence. And the bank that has the longest survival rate was the British Bank of West Africa. And this was not the case at all for indigenous bank, because indigenous bank, they had on average only 12 years of existence. And actually the median was 3 years, even lower. And for foreign bank, it was 50 years of existence on average, and mixed bank had 22 years on average of existence. So you could see that indigenous bank, or when nationals were part of the ownership of other banks, they had a lower survival rate than other banks. And here we have the deposit withdrawal and loans from 1887 to 1940. And you could see that these deposits, withdrawal and loan was steadily increasing until 1915, which correspond to the World War I. And then they started decreasing and increasing again until 1932, but at a slower pace. But then from 1932, they just increased fastly until 1940. However, what you must know is that this increase was mainly due to the activity going on in colonial banks, not indigenous banks. And that's what we wanted to show here. In this graph, you can see that the bank establishment and branches over the period is very, very small when we look at the colonial banks. So Nigeria Mercantile Bank or National Bank of Nigeria. However, for the Bank of British West Africa or Barclays banks, most of the establishments and branches were really for those two colonial banks, basically. So this dynamism, if I can call it like that, of the banking system was mainly led by colonial banks, not indigenous ones. And here I wanted to plot the exception that the National Bank of Nigeria represents within indigenous bank, because you could see that actually private bank deposit increased over the years for the National Bank of Nigeria. But this is just to say that it's an exception. It's very much an exception within the landscape of indigenous bank, because if you look at this figure where we have bank entry and exit, you could see that most of the indigenous banks, they failed right after they opened. And so the indigenous banks are represented in blue, and the orange color is for the year of bank failure. And you even had some banks that failed the same year that they opened, showing the fragility of such system. So after independence, in an effort to basically better control the banking activities and kind of deal with these successive failures of indigenous bank, the Central Bank of Nigeria was created in 1958. And the Nigerian government tried over the years to implement successive reforms from 1970 to date, actually. And these reforms went from nationalizations to the structural adjustment plan with some liberalization of the financial sector, for example, and so on and so forth. However, so they were really trying to kind of have an effective banking system, an effective financial system. Although there were different reforms and measures that were taken, that were not sufficient. And the combination of rising non-performing loans and high interest rate rendered many banks insolvent, and the banking crisis basically continued until 1994. In 2004, there was an important big reform that the CBN implemented, and that reform resulted in reducing the number of banks. So from 89 banks, there were 25 licensed banks. And one of the key measures of the reform was, for example, increasing the minimum capital requirement from 2 billion naira to 25 billion naira. So lots of banks disappeared after that, and some were merged with other existing banks. And of course, there was the financial crisis. And during that crisis, there was an audit that was asked by the Nigerian government, and the audit revealed that 9 out of 24 banks actually were insolvent. And in 2010, there was also some reforms to revise the universal banking model. And we must know that in 2016, there was an economic recession, and Nigeria was hit by this recession and tried to take some different measures to be able to reduce the macroeconomic vulnerability by, for example, strengthening banking supervisions, among other measures. And this is giving you a kind of a summary of what happened, since independence in the banking system. So here we plot the bank deposit and liabilities between 1960 and 2014. And what you can see is that during years of banking crisis, there was some weak economic performance. And this was characterized by, a higher ratio of non-performing loans to gross loans and a low ratio of bank credit to bank deposit. And because credit risk was increasing, banks started to kind of ration the credit. There was some credit rationing. And this credit rationing was also explained by the fact that the bank could not necessarily rely on a credit assessment system that will allow them to lend beyond the small groups. And we know that these small groups are, in most cases, composed of these related party to a transaction, and you had this small connection. And you would also notice that microfinance institutions flourish also during that time. And microfinance institutions are mainly based, their functioning is mainly based on insider lending and small groups. So if you have such a context and you have a multiplication of such institutions, you may weaken the banking system because you will have a systemic risk of having a banking system that mainly relied on insider lending. And of course, the bank in this context, they will be reluctant to provide more loans which will kind of lead to issue of a fragility of the banking system, issue of solvency, or even liquidity for the bank. So we have here, a table for the summary statistics, and there are two important variables here: the individual bank Z-score, which is a kind of a proxy for the level of bank risk and likelihood of solvency. So it is very low; it's minus 0.06, which means that there is a high level of bank risk. And we also have Herfindahl-Hirschman index, which is very high, 0.53, which means that ethnic concentration is very high. And put differently, it means that on average, there is a low level of ethnic diversity in the management structure of the bank. So here we have our econometric model. So with individual bank level data, we use the following pooled OLS specification. We have our dependent variable, which is the individual bank Z-score. We also have our main variable of interest, which is the Herfindahl-Hirschman index, which is measuring the level of diversity or ethnic concentration in an individual bank. We control for individual bank characteristics and also for the macroeconomic conditions that could affect the bank Z-score. We also control for a dummy for the year 2005, because remember that there were this huge reform in 2004. So we wanted to capture basically the context of what was going on during the time of the reform in the banking sector. And of course, we have epsilon, the residual for unexplained factors. And I just want to take a little bit of time to maybe just provide an explanation on how we calculated this ethnic diversity index. So to be able to capture diversity or ethnic concentration within the senior management and the ownership of a bank, we computed this HHI. What you must know here is that there are more than 250 ethnic groups in Nigeria. However, the most populous ones are the Hausa, the Igbos, and the Yoruba. So what we did is that we associated the ethnic, we take the ethnic group that was associated with the Hausa, such as the Fulani. So those ones were grouped into the Hausa group. We did also the same for the Igbo. So we took together the Igbo and people from the Niger Delta, for example, or the Calabari that were associated ethnic groups. And then we also had a group for other ethnicities. So these were basically people that we could not really attach to a particular ethnic group that were known in Nigeria, and also a group for foreigners. And then we computed this index. So SI here is the share of a particular ethnic group among directors and senior management of the bank over the 5 ethnic groups, and we sum them together. So this index range from 0 to 1. So if the index is below 0.15, it means that there is a low concentration and then high ethnic diversity. If it's between 0.15 and 0.25, we have a moderate concentration. If the index is higher than 0.25, it means that we have a high concentration and then low ethnic diversity. And 0, of course, means that high level of ethnic diversity, no concentration. And 1 means that there is only one single ethnic group, which is represented in the senior management. So here is just the definition of the variable that we use. I mentioned the bank individual Z-score, the HII index. We also control for liquidity ratio as a measure of the credibility of the bank. We capture if the bank is a foreign bank or not with a dummy. We also use as a control variable bank concentration, which is kind of capturing the level of bank competitiveness. We control for cost of contravention. And the reason why we did that is that because here the cost of contravention were basically the penalties that the bank were paying for not complying with the regulation. And we thought that could be a good proxy for a good proxy for the state of corporate governance. And we control for macroeconomic condition. I mentioned it early on, the GDP, of course, but also oil price, because oil represents 99% of Nigeria GDP. So anything that happened in the oil sector would have consequences in other sectors, including the financial sector. And here are our main results. As you could see, we have across estimates a negative relationship between the ethnic diversity index and the individual bank Z-score. So in the first column, where we only have the plain relationship between both variables, the sign of the coefficient is negative, but it's not significant. But as soon as we control for individual banks' characteristics, we keep the negative sign, but then it turns out to be significant. And this significant and negative relationship between the index and the Z-score is consistent even when we control for the dummy for the year 2005, or when we control for the macroeconomic conditions, basically. So what does it mean? It means that actually high level of ethnic diversity would decrease the bank level risk and would decrease the probability of having bank insolvency. So our findings here are in line with the literature that shows that indeed diversity is good for improving bank performance. And again, with diversity, you would have heterogeneity of ideas, diversity of backgrounds, people with different type of connections, different backgrounds and experience. And this whole helps basically to manage effectively a bank, which will translate into a better result for the banking system. And then as a conclusion, so this paper really uses historical data to investigate the relationship between ethnic diversity in the ownership and management structure of Nigerian banks and banks' performance. Our descriptive analysis show that indeed initial conditions matter because we had a higher level of risk for indigenous bank at creation compared to colonial banks. We also find a negative association between the index of ethnic diversity of the ownership and management structure of a bank and the individual bank Z-score. And this result is suggesting that ethnic diversity is important in strengthening the financial system. So what does this imply? Actually, these results imply that diversity can heavily influence lending and capital allocation, and they can also affect asset quality. So if you're in an environment where there is a lack of diversity, that can weaken the importance of skills and capabilities, which influences the bank performance. And if this is not mitigated by a strong external regulatory framework and having safeguards, those weaknesses can just contribute to increase the fragility of an individual bank. And we know that these banks are systemic by nature. So this could just lead to a propagation of a systemic financial crisis. And this highlights, again, the importance of having a continental or even a regional bank regulatory framework. If we can't do it maybe across all Africa, we can do it maybe in West Africa, East Africa, Central Africa, and so on. But it's necessary to have this independent cross-border supervisory authority. And finally, I think that these are really ways in which bank will need to be monitored and supervised, really trying to follow as much as possible international standards of best corporate governance. And we have seen across this paper that for doing that, ethnic diversity matter and should be taken into account. Thank you very much.
Thank you so much, Linger, and the co-authors for this wonderful presentation. So just we're going to have some questions in the Q&A, but just to start with some reflections, I found this a fascinating paper to think in relation to also the kind of role that Nigerian financial sector development plays as a blueprint in other African nations. So for instance, in Ghana, where I've done field work in the banking sector, they often looked up to Nigeria's central bank and the history of Nigeria's banking sector development as some kind of almost like an inspiration that one day that our banks may become as strong as the Nigerian banks. The Nigerian banks were sort of role models to aspire towards. So I mean, just to start thinking that when thinking of this development, the historical development of that included such proliferation of Nigerian indigenous banks, like starting from, of course, from the independence, but already before. I was astonished in your paper when at some point, was it 1991, when there were 120 banks in Nigeria. Then it went down to 89, then it went down to 25, and now I believe it's 19. So when thinking about what kind of aspirations drove the sheer starting, like the process of starting a bank, starting a banking institutions, how would you think about that in relation to the kind of ethnic family dynamics that we were talking about? And the kind of, as Nigeria is often considered as the country that actually has had quite strong domestic capitalist class compared to, for instance, Ghana, where it's been more with the in terms of the political elites, that how that have collided. So I was very interested to hear your thoughts on that, the sheer institutional proliferation of these banks, among many other questions, but just to start with that.
Should I answer now or should I wait until we collect all questions?
We can start by that and then we'll continue. Yeah.
Okay, great. No, that's a great question. Thank you, Anna-Rika. Actually, you were right. They were a kind of proliferation of banks, and that justified actually all these reforms that you've seen. And it's because of the reforms and kind of an attempt, if I can call it like that, because the reforms were all not that successful. Some were more successful than others. And it's because of this proliferation of banks that those reforms was put in place to put a little bit of regulation and kind of have a good size, I would say, or a reasonable number of banks. And then to directly answer your question, I think indeed you're absolutely right. We can date this during colonial time and this need and the idea of, remember, it all started with protesting. Why these banks are lending for business and business developments for the British while they are not lending to us, and it all started with this idea of not only an idea that was true, there were some discriminatory practices against Africans and Nigerians. So, and I think that idea really kept going on, and it kind of also was persistent over time. This need to be able to have some banking system that would support the business. So do not forget that Nigeria and even lots of African countries, they are very much dynamic with regard to entrepreneurship, for example, and starting a business. And of course, most of these businesses are in the informal sector, but still you have that, culture, I would say, of entrepreneurship, even if it's an informal one. And you need funding for that. So you need investment for that. But do not also forget that most of the people, they're outside of the formal institution and outside of the banking system. So it's kind of very much complex, but I think that also that help basically have an idea of what shaped the banking system in Nigeria and how this started flourishing across Africa, for example. And it's very much related to also social norms and cultural norms about entrepreneurship and the desire to basically invest. So I know that Lisa is also connected, and Jan, I don't know if they want to add something to that. No? Okay. I hope I've answered your question. Anna-Rika.
Surely, thank you very much. We actually have lots of questions to go through. So let's start from the Q&A chat, and then we move on to somebody raised their hand as well. So first, Stefano Battilossi has asked a clarification question. Is the HH index based on historical data, or is it just for the period 2001 to 16? So that's just a clarification question. Then Miley Savaro has asked, do you have any microhistorical evidence or anecdotal evidence showing mechanisms through which the ethnic diversity was beneficial for the governance? So let's start with those two, and then we'll move on to the next.
No, I'll start. Thank you very much for the questions. I will start with the last one on the anecdotal evidence. So in some of the references, yes, actually in the dissertation by Uche, you would find those anecdotal evidence, but I agree that we could maybe rely more on this to be able to kind of shed light on the results and the descriptive analysis that we're having on. So definitely, I think there are some, but we haven't used them as much as we could, for sure. So thank you for the more suggestion than a question, actually. And for Stefano, so the HII index, we had it for, we didn't have it for all years, right? Since independence, we didn't. However, most of the information that we have for the index from the year of foundation of the bank. So for the year of foundation of the bank, we were able to gather lots of information on founders. We also had lots of data for the year 2005, because that's the year right after the reform. So it was very much documented. So there was a lot of information on the senior management of the banks that were in place in Nigeria in 2005. And we also had a lot of information on in 2016. We do have information on other years, but these were really the three main data points for which the index were the most informative, I would say. So we were not necessarily able to track the ethnicity of the senior management and director for all the years since pre-colonial time. We tried to do that, and we would have loved to have that much information, but most of the information we had was basically for those 3 points of data, those 3 years, basically foundation around the economic reform, so 2004, 2005, and later on in 2016. Otherwise, there was a lot of holes, if I can say that, across these dates, basically, between these dates, sorry. Yeah, thank you.
Great. Then move on to David Mitch has asked about the differences between the north and south of Nigeria, and whether there are some significant differences that influence the story, and how does that difference influence the evolution of the banking sector. Then he also asks, could your findings on ethnic diversity of management reflect differences in portfolio diversification? And did banks with more ethnically diverse management have more diverse investment portfolios? And then whether more ethnically concentrated and managed banks reflect more chronism in loans. So that's one set of questions. Then I'm going to ask another one. Orkun Saka asks, have you explored if there are any non-linearities in the relationship between diversity and bank failures?
No, these are great questions, actually. Thank you so much. For the first question on the northern and south part of Nigeria, so basically, you would have different ethnic groups located in different regions, right? The south, for example, you would have more like the Igbos there in the south. So the differences between region is mainly the composition of the ethnic groups, basically. That's for the clarification question. I really like the question on, if difference, having ethnic diversity would have an incidence on the portfolio and so on. We haven't went that detail in the analysis, but I think that's a great follow-up. And actually, we could do it even in this paper. We haven't done it, but I think it could be interesting to look at the association between, indeed, the level of ethnic diversity and differences in terms of portfolio and so on. So yeah, so that we haven't done it, but we should definitely. Thank you for that. And the issues of non-linearities, what we could do is take the index that we have and maybe introduce in the regression analysis the index and its squared to see if indeed there will be some, I would say, optimal level of ethnic diversity, for example. If I understand your question. So I think this is a great suggestion. We could try to do that, try to look at some non-linearity by having the index and index square and look at if we can have some turning points, for example, and maybe why not calculating the turning points, at which moment we can say that this ethnic diversity is optimal or not. That's definitely something we could explore. Thank you. It's a great point.
Great. So then Orlando Zambrano Roman says, super interesting paper, 2 questions. Could you highlight the importance of alternative banking institutions, for instance, Islamic banking in this context? And secondly, how does this paper fit in the literature of higher ethnic diversity and worse development outcomes? For instance, higher violence, less trust, less entrepreneurship, etc.
Yeah, no, I'll thank you, Orlando, for your questions. I start with the last one. Actually, in the beginning of the paper, I was mentioning that indeed, actually, the literature on the impact of ethnic diversity on performance is very mixed, right? And I think the paper is shedding new light on this literature, because on the one side, you're right, you would have evidence showing that too much diversity would not necessarily be good for economic performance and growth and can lead to actually instability. But then you also have a new strand in the literature showing that if you take firms' performance, for example, actually it might be good to have some diversity. So, well, the reasons that we are finding this negative, this association, I would say, positive association between ethnic diversity and good performance of banks is basically responding to the side of the literature. It's basically more in line, if I can put it that way, in the empirical evidence showing that diversity may be good, basically, for the functioning, at least for the functioning of the banking system in this context. All right, so that's what our findings are leading to. And also, there would be a lot of things to say about ethnic diversity and economic performance, by the way, but I think there is not much time for that. Maybe during the informal session, we can discuss it, because it's very interesting and it's not straightforward, actually. And I think really the finding of our paper is adding to the discussion and saying that we have to be careful, because that relationship is not that straightforward. And there was a first question on, I am not sure I have understood your question actually on the banking system and the Islamic banks. I'm not sure I have captured well the meaning of your question. Or is it like, how does this paper fit into a landscape where you have all this type of banking functioning, right? I'm not sure I have the answer to that question if I've understood properly, but what I can say is that, again, we must keep in mind that in African countries in general, and Nigeria is no exception, most of the people that are out of the formal banking system. And now with, for example, the increasing of mobile money, for example, where you can have basically a bank account just with your phones, people are finding different ways to be part of the financial system. And these actually alternative ways, I would say, are providing option to get access to credit, but also to have some saving or even get access to some insurance mechanism. So the landscape is evolving. There is still an issue with the formalization and having more people in the formal banking system, but people themselves, actually, communities are finding ways to deal with this issue and the fact that they are outside the formal banking system. There are new ways, and digitalization in one of them. Financial inclusion through mobile money is one of them. And this is actually good news, right? This is actually good news because, again, you can provide this type of services to a huge part of the population that would not have access to financial services otherwise. Back to you, Anarika.
Sure. So I would like to invite Samuel Segura Copos, who I believe raised his hand earlier. So let me just unmute if you could ask your question. Are you able to come in? I think I've unmuted you. Samuel Segura Copos, who raised a hand. Hello? Can we hear you? Okay, maybe we come to you because we can't hear you at this moment. So maybe Nathan, if you'd like to come in at this point and ask the question, so then we'll try to get Samuel after that.
Thank you. Thank you for a great presentation. I mean, we're kind of running out of time on the formal part. Just a quick question. To what extent are you capturing the size of the bank when you're talking about the diversity? Because in the regressions, I don't see control for the bank size in some sense. So it makes sense that smaller banks would be less diversified in their board membership or management in general, as opposed to large banks. And if this is true, then this could be some kind of an interesting benefit for agglomeration, because usually we talk about systemic risks and all this kind of macroprudential reasons. But if larger banks allow for more diversity than smaller banks, and this is beneficial apart from the size, then this could have some silver lining to bank size and their efforts to obviously make the banking system more competitive and break down the big banks, etc. But if this is some just reflections on that, because I know you're also interested in the macroprudential issues.
No, thank you so much, Nathan. And this is a very relevant point. Actually, you're completely right. We are not controlling for it so far, but that definitely could be an important control. And this would be even more important because we've seen, we haven't mentioned it in this version of the paper, but we've seen that actually diversity, although there is still a lot of ethnic concentration, it has kind of increased over time as well, right? So it would be interesting indeed to see if this changes in the level of ethnic diversity is also correlated with the size of the bank and the evolution of the bank itself, right, in terms of performance and so on. No, thank you very much. I think, we'll try to do that, at least at the minimum control for it and see how the results are changing with or without controlling for the size. Yeah, thanks.
Okay, thank you very much for all the questions that have been asked to date. So I would now like to close the formal part of the webinar, which is going to be followed by 15 minutes of informal discussion. So please feel free to stay on, especially the ones who didn't yet get the chance to ask the question. So just to remind you that next week is going to be the final seminar of this spring, this season of the macro history seminar series. And it's going to be given by Wolfgang Keller from the University of Colorado, titled The Economic Consequences of the Opium War. So please join us next week for that, the final seminar of the spring. So at this point, I believe we can just basically unmute ourselves and come to ask further questions from both Linière, as well as we have one of your co-authors, John Gerson, here as well. So please feel free to join in and continue the conversation.
Jana, can you hear me? This is Samuel Segura, and I was trying to brilliant sorted out the technological issues.
No problem.
In listening the issue of diversity, which I find really fascinating, I think most of us have actually found it that way. It kind of reminded me a little bit of a discussion that Admiral Greif in his 2006 book on institutions and the path to the modern economy kind of raises, which is the role, like how horizontal groups and societies tend to be less integrated and have some problems. As a matter of fact, with generating trust and so on through formal institutions, whereas vertical societies that are more fragmented tend to do a little bit more, a little bit better on the formal or legal aspect. So I thought, it would be kind of an interesting element to incorporate perhaps in the paper, in the discussion of the framework, because it really resonates a lot. And also it seems to be that there's an issue of transition from, like a personal links-based society to an impersonal, to more of an impersonal economy, right? Through these different means. And it's just something really, really interesting that kind of comes in there. And in particular, because Greif, he mobilizes the example of the Genoese traders and compares it to the Maghrebi traders. And this is in the context of European economic development, right?
Samuel, can I come in?
Yes, of course.
Oh, okay. I was not sure that you were done actually. No, thank you very much. I think this is a great suggestion actually, and you were right. And maybe, I mean, it's more a suggestion than a question, but maybe just to comment on that, it would indeed be interesting to look at complementing what you say, how those networks and social networks, they evolved over time, right? Because indeed, if you have in the very beginning, as we said, all these insiders, basically family members, affiliated, and so on, again, over time, there was some diversification, basically, and a lower ethnic concentration, although ethnic diversity was still low. However, I think it would be interesting to know who were the newcomers, basically, who were the one that brought this additional diversity, and kind of making linkages and look at how the trends evolve over time. Yeah, no, definitely. Thank you. I think that's a great suggestion. I'm not sure that because the data that would probably involve also new data work. So I'm not sure about the extent.
That's for another project, I think.
Exactly.
But so, I just think that you have some very interesting leads on that regard.
No, thanks a lot. It's yeah, it's very interesting actually, and yeah, that's definitely, that could be a nice follow-up for sure. Thank you.
So could I invite Rui to come in at this point? You raised your hand.
Thank you. Thanks, Lingar, again for the really nice presentation. I'm afraid I want to go back to the historical part of your paper, since I'm a financial historian, and we discussed perhaps enough on the contemporary part. So something must have happened in 1953 because there's a large entry of indigenous banks that failed pretty quickly, and for someone doing financial history, that sounds like a banking crisis. So am I correct? And what drove this big wave of banking? I don't know if incorporation, but this big wave of banking creation in the period, and why did they fail? And having failed, where did indigenous banking entrepreneurship go? So, I guess the question here has to do with the shadow or the non-formal banking sector, right, or credit sector. Right. So we all know that it's still very important in countries such as Syria. I imagine that among the backdrop of these mistrust on colonial institutions, it necessarily had to be even stronger back then. So do we know something about things like credit cooperatives or credit granted by religious organizations such as missions, pawn shops, Ponzi schemes? Do we know anything about that? Thank you.
Thanks, Rui. Actually, you're right, actually, to notice what was happening around 1952, 1953. And what happened is that because there was this proliferation of indigenous bank, there were an ordinance that came into place in 1952 to regulate the banking system. And that's why you're seeing a kind of a drop and a failure of lots of indigenous bank. And actually, it even didn't stop there, because after 1952, there was another ordinance in 1958. So during that period of time, so you had the first ordinance, so they kind of cleaned up, I would say, because there were a lot of banks that were not licensed. You had these unlicensed banks and so on going on. So there were some kind of regulation put in place. So that explained the kind of a drop, and that many indigenous banks disappeared after that. But this even continued later on. And 6 years later, you had another ordinance to go further. And that's why you had a huge drop between 1950, I would say, and 1960. Basically, it is 10 years before independence, of creation and disappearance of banks almost right after they were created. Sometimes even, I say, the same year that they were created, actually. So that's for the first point. For the second point, there were successive reforms in Nigeria, and there were lately a reform, for example, that kind of reformed the universal banking system. But what we must know is that at some point in time, and this is still true today, you have, for example, the microfinance institution. You would have, I'm not sure you would put that in an informal, because it's in an informal banking system. It's not the commercial banks as we know them, but you would have a proliferation of microfinance institutions, but you would also have other organizations that would be able to provide some loan, right? So and those institutions, they are basically there because, again, the share of unbanked people is still huge, actually. So you still have the formal system, but not everyone, actually it's a minority that can access the formal banking system. So you indeed have, in addition to the formal banking system, different type of institution. Microfinance institution is one of them. They are also there to be able to provide some lending and some loans to most of the people that remain unbanked, basically. I'm not sure that I have answered your question, but
no, I understand that very well. But if I may just quickly come back, so I got the part about the ordinances that sort of clean the system. What I wanted to know is why there was this wave of indigenous bank foundation, because it's pretty striking in your figure 5, right? There's a few banks that are created before 1951, then all of them are created in 51 and 52, and they all disappear because of the ordinances. So what kind of financial, volatility or activity was driving this big incorporation?
Actually, it was more. I mean, in the very beginning, it was more ideological than financial, actually, because you had those Nigerians, those Africans that wanted to access credits and going to the existing colonial banks. I mean, they didn't start by starting up their own banks. They were first going throughout the existing banks, and it happened that the existing banks were the colonial banks. However, those colonial banks were not necessarily interested in lending to the Africans for business purposes, right? It may not just be for just being discriminatory, but they were more interested in lending to British people, the one that were doing business and that was investing, exporting and importing, and so on and so forth. So they were not necessarily interested in lending to Africans. And then because of that, they were also the Africans were also perceived as being less credit worthy. They probably had less capital than the British ones and so on. So because of, and they started practicing different interest rate, for example, towards this African and Nigerian, and basically having different conditions between the British and the local ones, the national ones. And that actually put together with the ideology of, okay, we have this colonial banking system that are coming to us, but they do not want to lend us. So we're going, as a way of protesting against this system, we're going to create our own banks, basically to serve our own interests, right? And that's really justified the first wave, if I can call it like that, of bank creation, of the indigenous of bank creation. And again, it's in the paper, but of course, that's the problem with ideology, right? The reality may be very much different from what you believe at the first place, because the intention was there to be able to have our own banks and fund our own interests and maybe fund our own projects and invest and so on. But the capital was not necessarily there. The management skills at that time was not necessarily there. And then that explained why you had all these banks that were created, indeed, but then they fail almost right after, and also some mismanagement. I mean, we have to also say the words as they are. Yeah, but I mean, what I mean here, maybe to summarize and sum it up in one word, is that it was not necessarily only for economic purpose that these banks were created. They were the economic reasons because they wanted to get funds to invest in their own project. However, it was more of a way of protesting against discriminatory practices and not being able to access loans at the same conditions as the British.
So I would like to invite Stefano Pattilossi, who had raised his hand. Can you join us to ask your question?
Yes. Thank you, Dr. Bayer, for this very interesting talk. I wanted to ask you to elaborate more on what is the shadow of history you see in this story, because on one side it looks like basically the ethnic fragmentation of the Nigerian society is what you capture with your index. So this is sort of permanent over time, and this is the legacy of the past. But I wonder to what extent you might cast your story into a richer historical framework, looking at for example, the dynamic set in motion by the process of decolonization. So imagine that you have a society which is heavily fragmented along ethnic lines. And so you have also very strong cleavages along ethnic lines in the independence movement. The political mobilization for independence follows very clear ethnic paths. I was curious, but when I was reading your paper, I just have a look at historical details, and so it looks like that President Azikiwe very early left the what was called the Nigerian youth movement, because he thought that this organization, which was led by Yoruba leaders, basically discriminated against Igbos population. So it looks like there is a clear pattern of ethnical fragmentation following in the process of political mobilization leading to the independence. So I wonder to what extent in this specific setting where you have lack of trust among different ethnicities, you may have a dynamic in which each ethnicity tends to create its own sort of banking subsector. And then this huge fragmentation, this proliferation of indigenous banks is preserved by a system which is heavily regulated and as a consequence, there are large or significant rents that allow inefficient banks to survive. And then you have a shock, which is so I think it is something that it looks like is going on both before the independence and after independence. And I would be interested in knowing more about this historical dynamics around the event of independence. The second comment is a suggestion. Since you have the first big episode of banking crisis in the early 1990s, and it looks like this is the classical story of the liberalization and the regulation of a heavily regulated system, so what we call financial repression. And so you have a big shock and many banks fail. So if you are able to track the ethnic composition of directors or owners of the sample of banks that were operating in Nigeria in the early 1990s. And so you may have sufficient variance in failing and non-failing banks, and you can specifically identify the ethnical characteristics of these banks. Perhaps you may have an interesting historical exercise and ask to what extent banks that were less ethnically concentrated were less likely to fail in the big wave of banking crisis in the early 1990s.
Well, thank you, Stefano, for these great questions, actually. I think your last point is related to Samuel's point as well. Actually, we tried, to be completely honest with you, but we really had some hard time to find information. So what really we wanted to do, ideally, what we would have is having for each year, at least even not even going back to independence, but let's say that we start in the 1990s and having for each of the bank, for each year, the composition of the senior management. That would have been fantastic if we managed to have, that level of information and that detail of information over time, because then that would kind of help us indeed look at, if we had more or less ethnic diversity over the time. Actually, we observed that there is more ethnic diversity over the time, over the period. But then if we had that information, we would be able to know the composition. And even when we talk about diversity, are we just still having the three main groups, for example, or do we have more ethnic diversity toward other minorities, for example? These type of details would have been very much interesting, right? And seeing to how these the ethnicity, the composition, I would say, in terms of ethnicity of the senior management and its evolution over time. We really tried, but I'm not saying it's impossible. I think it's possible, but that would require lots of data collection again to be able to fill those holes that we have for the index, basically. And for your first question, I think that's even more a suggestion than a question, but I think it also relates to a question earlier on the difference between the north and the south of Nigeria. And the south is actually, you will find more Yorubas in the south. I said Igbo, that's all the way around. You will have more Yoruba in the south. And maybe to answer your question, what is important to know is that we've noticed at foundation that was the Yorubas actually who started mainly, who started the indigenous banks. So the first indigenous banks, I think 80%, if I remember correctly, the figure of those banks were first started by the Yorubas that you mainly find in the southern part of Nigeria, basically. And if I understand your question, it even goes beyond the context of Nigeria. It's really looking at how this ethnic diversity are shaping basically the social context, but also the economic context, if I understand it properly. And this is true everywhere in Africa. We know that these cultural norms, these social norms are extremely important because they shape the behaviors of people, right? The trust issue. You all probably know this paper by Noon and Wanshek on how basically the initial condition, again, the slave trade have negatively impacted the level of trust that we observe today between ethnic groups in Africa, for example. So just maybe coming back to our story, the fact that the first banks, the first indigenous banks were created by insiders, right? People belonging to the same ethnic groups, knowing each other. You would have some political affiliates or sometimes even family members. If you look at the records, you would have in a senior management a person, and you would have his family members that are part of the board. And this is even like beyond ethnic diversity. It's really like you're basically doing business with people of your own family. So even actually within an ethnic group, you may have issues of trust, right? The trust level can even be different from one ethnic group to another. But even within an ethnic group, the level of trust can actually be different, and that can also shape the relationship, but also performance of firms or of banks and so on. And if you look at, I know I'm diverting a bit from the topic, but I find it really fascinating. Sure. If you look at, I think there is a paper on entrepreneurship, and I don't really remember the authors, but that was basically showing that in Africa, for example, if you look at entrepreneurship, you have many people that, because these are very small enterprises, micro and small enterprises. So you will have someone who will start a business, and most of them, they hire people from their family circles, for example, or their friends, because those are unemployed and they want to help out. And this can actually be not a good thing for the performance of the business, because those are not necessarily the most qualified ones. But you would have a pressure, a social pressure, that if you start a business and you're making money, you should be starting by helping your people first, even if they are not the most competent one. And really, this is just to say that all these dynamics around the social context, around the cultural norms, they are at play and they matter. And they are very much important at a very micro, small level. But we've seen that they can also be associated to, to banks' performance, or even affecting an entire banking system. So I think these are fascinating. I can keep on going on and on, but
no, but you just confirmed that you have a huge amount of very interesting historical research that makes for a very interesting financial history, banking history paper beyond what you have already produced with this paper. So I would encourage you to pursue further this research project, because it's very interesting and fascinating.
Thank you so much. Thank you.
And we hope that the conversation can continue in one form or another. This has been a fascinating discussion. Thank you so much to all the attendees, all the participants, for excellent, wonderful questions. Thank you to Lingere, to all your co-authors. Yeah, we hope that we will meet again on another occasion. This was very fruitful conversation. I hope it was useful for you too. So I guess we finish here, and we look forward to the next conversation. Thank you.
Thank you.
Thank you. Bye-bye. Good
Bye.
evening.
Thank you so much, Anarika. I don't know what happened. Are you still there?
Oh yes, I'm actually still there, but I don't think we're